So Sunil Subramaniam is joining us now from Sundaram Mutual Fund to talk more about markets. Sunil, afternoon. Thank you so much for your time. Sunil, I want to start our discussion today about how's the spending quality happening in the economy, with a reference which was mentioned by Prime Minister Modi over the weekend in his regular talk show Man Ki Baat, saying that there was 4 lakh crore worth of festive buying which happened across categories this year. You talk to a lot of companies, your team talks to a lot of companies on ground. Across categories, are you witnessing buying coming back?
Yes, indeed, top-line growth is definitely back, right? Of course, margin-wise, different companies and different sectors express different views overall, but the earnings season also has been overall positive. But definitely, top line, we are seeing that good. And I think for the when the January quarter results start coming out, you will see good, healthy top-line growth from the festival across the consumption pack.
So, if top line growth is coming back indeed, and the general view is that by mid of next year, inflationary peak would have happened, and then the commodity prices will actually start coming down. They're already coming down from top. Would it also not aid margins of corporate India?
Not necessarily, Ajay, because the key is competitiveness, right? How much of the easing commodity costs would be passed on and how much would be at the altar of getting market share, right? So I think that we are going to see a very, very hot, if I may say, summer coming up when there will be, because you remember one thing, that premiumization of consumption has been a story for some time now. You have auto cars like SUVs above 7 lakh already doing well. You said big houses selling well, but the bottom of the pyramid, the two-wheelers, the entry-level motor vehicles, that's where the growth was not up to expectation, because I think the people at the bottom of the pyramid were not spending. Now, if you see the coming days, that's where there's going to be a heavy push to kind of push the stock. So I'm not going to say that obviously with commodity pricing you're going to see margins increase. Actually speaking, I would rather companies sacrifice margin at the altar of growth, because getting growth back, it's also positive from the fact that capacity utilization has kind of frozen. We were very upbeat about a year ago saying it's gone up from about 72 to 75, but it's got stuck at kind of a level, and unless it grows past 80, the capex boom will not happen. So from an overall situation, I would rather see that the consumption pack sacrifice margins for growth at this stage, because that will have a multiplier effect on their own business as well as the overall economy.
Also, this is an important week because of the state election results which would actually come out by weekend. Is that a factor? I want to understand how big a factor. If 1 or 2 states come BJP's way, the narrative was that they will lose all state elections and they will win national elections. If anything comes their way, even in state elections, will the market read incrementally positive?
See, I think you expressed it very well there, because I think so far the market's behavior is indicating that they are not worried about the December 3rd result, because they are more focused around the May 24 result, where I think everybody is fairly confident. So I was expecting a little bit of nervousness around December 3rd, but honestly speaking, the market is not showing that, probably because the international slowdown scenario means that India is being more favorably looked at. So flows are pretty strong. And as you know, domestic flows have been strong. So clearly, fund managers are not going to sit on the sidelines of the December 3rd result, right? So I don't think that. Second thing, you mentioned that what if the BJP actually sweeps the Hindi states? See, because look at this election, you have the Andhra, Telangana pack and the Mizoram pack, where results could go either way, and nobody expects BJP to really do well there. But in the 3 heartland Hindi states, right, you have an expectation of anti-incumbency in Rajasthan. Then you have whether Madhya Pradesh will show that anti-incumbency or not. And in Chhattisgarh, also there's talk. So if they turn to be positive for the NDA, definitely some of the money that's sitting on the sidelines in terms of some retail investors, some HNIs, some speculative hedge fund money could then come in, because their confidence around the May would be reinforced. So yes, a possibility of a sharp uptick if the December 3rd results go the right way is a distinct possibility. At the same time, like I said, there's no nervousness in the run-up over the last few days. So market seems to have pretty much discounted the impact of these results at this point in time.
You're right, Sunil. I mean, market, is it earnings results or any other results? Market, the treatment of the market is same. What's in the price? Is anything happening over and above or below what's in the price and the reaction? But okay, we'll move on. The other thing which market has started to talk about, but the opinion is pretty divided, is rate cuts. I was just speaking with Chetan Iyer of Morgan Stanley on my show the earlier, and he was saying that Indonesia and India would lead rate cuts in Asia by mid of next year. Assuming it does start that way, when will the street start factoring in possibility of rate cuts in India?
I think the street will start just around the budget, because the budget, while it's not a real budget, it's going to be more of a vote on account, will give a state of the finances of the government, the state of the current year, what was the projected versus the actuals, and it'll give a cue around the fiscal deficit. Because ultimately, remember, in the longer term, it's a fiscal deficit which feeds into interest rates and into inflation. So if those numbers come around the expected numbers, right, and so far the tax collections have been high. On the expenditure side, also the government has been spending more on infra and less on consumption. So I think the Feb 1st data, when it comes out, then the market will form up its opinion on saying, is there going to be fiscal pressure on the RBI governor? Number one. Number two is, I think from what we hear, the granaries of the government, the FCI godowns, are reasonably well stocked. So the ability of the government to control supply side inflation, I think, is also increasing in confidence. So I think Feb, March, when all this data comes out in the pack, is when the market will start discounting a possible rate cut. And you could see the next leg of a rally where there is clarity around those thoughts. So that I think we are all set for a pre-election market highs.
Fair point. Sunil, how did you look at the quality of earnings this time round? Do you see the earning momentum will likely continue, or one view is that from December quarter onwards, it could decelerate?
I think that, like I mentioned in the first question, the answer, right? I expect good top-line growth coming in this quarter. How much companies have left margins at the stake of getting top-line sales happen, the results will show. So I think that the earnings season so far, we've seen cement and the energy pack do well because they're coming off a low base. Right, we've seen some slowdown in consumer discretionary in terms of earnings, which I suspect is the margin pressure showing up. So I think that the story for the next quarter is top line rather than the margins. Banks also shown a very healthy growth, but there you got to dissect the fact that some amount of provision write back, because they obviously hiked their provisions during the COVID and the post-COVID phase. I think there's been write back because situation hasn't been alarming, and the write back of provisions has helped protect margins of banks. Now, as the impact of that write back goes away, you will see that NIMs actually have been shrinking, but the top line growth, right, which is expected in the coming quarter, should make up in terms of EPS. But for a quarter at least, I see that the NIM pressure on the banks will show up when they have finished with writing back the provisions. So I'm of the view that for the next quarter, the focus will be more on top line, and margin growth will be more stable. And I don't think an expansion of margins will be the order of the day when the quarter results come out.
Right. Before I let you go, Sunil, I want to talk about one section of the market which was very overowned, had become overowned, which is banks. And within banks, there are certain names which have just not done zero returns for last 2-3 years. What are your thoughts? On when will the street start normalizing them? What triggers? What are they waiting for? What exactly is happening? Because these are widely known big banks, right? What I'm referring to. Do you see in the next 12 months some kind of a mean reversion may happen?
So I think that what's happened there is that what's happening in the banking space, right? And you'll then realize why the names that you're speaking about, which is the larger banks, have not delivered returns. Because the initial story was of a combination of a low-cost base, which they had acquired of deposits, of international funding, rupee-based masala bonds, and all of that during COVID, where they took advantage of the soft interest rate scenario and the ample liquidity to lock on to long-term liabilities. That plus the fact that retail lending in the consumption space, right, was also coming and helping them to drive their top line. So they were seeing NIMs expanding with the loan book also expanding. So that's what led to the initial post-COVID rally in this, right? Accounted also by the fact that 35-40% of the large cap index is the BFSI space, and passive money coming from abroad also gave it. Now, the point is, what has happened is that in that period, right, these should have fallen, but they didn't because of this buying support, right? So now what's happening is that you're seeing that the low cost funding has been already deployed. Fresh deposits are obviously coming at higher costs. So naturally, NIMs are also, and you've also had some amount of competing pressure in the retail side. And now latest, you've seen RBI also come in with those additional provisions on the retail lending side. So clearly, larger of these grew large on the basis of their retail lending book and low cost. Now, the reason that the market has suddenly felt that they probably need to provide more in terms of capital adequacy for that, so their ability to lend more will be, and the history of a low cost base is now repricing itself at a higher cost. So that's why. Whereas what's happening is that the money which is coming into the market, right, is got now diverted, I would say, away from these where this story is dominant to, let's say, a PSU banking space, which has historically always been at a much lower price to book, right? So plus with a much better CASA base because of their nationwide presence, right, where the drop in the cost rise will not be so much less because they have much higher CASA base to support low cost CASA base. So that plus the fact that the next 18-24 months, the focus is going to be on corporate lending, where historically PSUs, right, because they have larger balance sheet with the government support to go and do big ticket lending, right? In the corporate space, there is not that much competition for them because NBFCs don't participate so much in term lending, and the larger banks are a bit wary about corporate. As a story, if you see, by and large, they have stuck to retail as opposed to corporate, basically from a diversification of their portfolio. That's the story of the larger banks' growth. But the new age is going to be a corporate lending growth where SME lending, for example, is going to, because the capital goods suppliers, they will be largely in the SME segment. PSU banks have much closer relationship with the SMEs. They've stuck with them through thick and thin. So I think the market is tending to feel that price to book valuation gap between a PSU pack of banks and the larger private banks, right, is probably going to narrow. So there is a search for that opportunity. And I think so within the banking space, this capital flow has diverted away from these well-known, well-regarded names with no concerns, but the future growth prospect because of these three factors that I mentioned, right? That the retail lending growth will not be as good as the corporate lending book. Second, their low-cost base is now got used up in lending, and so new liabilities are coming at higher cost. And the third factor is that in corporate, they were not that keen to do large ticket corporate loans, but PSU banks are much keener. Hence, the valuation gap is probably is driving a little more capital towards the lower price to book PSU bank names. And there are good quality banks even there. So I think that's a reflection of the situation. That doesn't mean there's a cause for worry, because if you are 35-40% of the index, then you are contributing to the safety aspect and the lower volatility of the index. So they will continue to get that buying support. So it's not like you're going to see a major correction also. So I would say that as part of a safety pack, these larger banks still have a role to play, and they're going to be more consistent in terms of the thing. But temporarily, there's a diversion of capital, and that's why you're seeing a faster growth rate in a PSU banking pack or a smaller bank pack, so to speak.
All right, Sunil, we'll let you go on that one. Thank you so much for your time.